Picture this. You've worked your whole life, built a solid nest egg, and now you're finally in retirement, or getting close. Your Social Security check is coming in. Medicare costs are managed as best as you can. But then tax time rolls around, and a big chunk of your savings gets eaten by ordinary income taxes, year after year. It feels unfair, right? Like the government is quietly taking more than it should from the money you already paid taxes on once. What if there was a way to flip the script? To pay taxes now at today's rates and never pay them again on that money or its growth. That's what a Roth conversion can do. But most retirees either skip it entirely or do it wrong and end up paying more than they should. In the next 10 minutes or so, I'll walk you through whether a Roth conversion makes sense for you in 2026, how much might be smart to convert, the best timing, and, most importantly, the 5 biggest traps that could turn this powerful strategy into a costly mistake. Stick with me. This could be the move that protects thousands of dollars for you and your family. But before we go any further, this is for general information and entertainment purposes only. It's not personalized financial, tax, investment, or legal advice. Tax rules, brackets, and Medicare impacts can vary based on your unique situation and change over time. Always consult a qualified accountant, financial advisor, or tax professional before making any decisions. Planning involves risk, and no strategy guarantees results. We've talked about Social Security claiming strategies and the 2026 Medicare premium hikes that can quietly offset your COLA raise. But there's another piece that often gets overlooked: taxes. Right now, in 2026, tax rates remain relatively favorable after recent adjustments. Top rate, 37%, brackets stretched with inflation. Future rates? No one knows for sure, but many experts expect them to rise eventually. A Roth conversion lets you move money from a traditional IRA, 401k, or similar pre-tax account into a Roth IRA. You pay ordinary income tax on the converted amount this year, but then all future growth and qualified withdrawals are tax-free for life. No RMDs forcing you to take money out, no taxes on gains, and your heirs often inherit tax-free too. It's not right for everyone, but for many in the 55 to 70 age range, especially those in a lower bracket now than they might be later, it's one of the most powerful tools left to control lifetime taxes. Let's look at whether it fits you and how to avoid the pitfalls. Trap number 1, converting too much on 1 year, the bracket buster. One of the most common and expensive mistakes is dumping a large amount into a Roth all at once. Say you're in the 22% bracket now. Convert $100,000 in 1 year, and suddenly you're in the 24% or even 32% bracket. You pay more tax than necessary, and it can trigger higher Medicare IRMAA surcharges 2 years later, based on this year's income. Real example, a couple in the 24% bracket converts $80,000. They jump up to 32% on part of it and pay $10,000 extra in tax plus IRMAA bumps. Spread it over 3 years, and they stay in the 24% bracket and save thousands. The fix: convert only enough to fill your current bracket. Use the IRS tax tables or a free calculator like the one at irs.gov or dinkytown.net to model it. Start small, maybe $20,000 to $40,000 per year, and see how it feels. Trap number 2, waiting too long or ignoring market timing. Many people think, I'll do it at the end of the year, but early 2026, right now, can be ideal. Markets are volatile. If stocks dip, your IRA balance is lower. You convert less principal for the same tax hit. More shares move to Roth, for future tax-free growth. Waiting until December? You miss the chance if markets rebound, or you rush and convert too much. Also, 2026 brackets are inflation adjusted, but if your income spikes later, bonus, capital gain, or RMD start, you lose the lower bracket window. The fix? Review your income early in the year. If you're in a dip or low income period, consider converting in Q1 or Q2. Spread conversions over multiple years to smooth out taxes. Trap number 3, falling into the Pro-Rata rule, especially for backdoor conversions. If you're a higher earner and do a backdoor Roth, contribute to traditional IRA, then convert, watch the Pro-Rata rule. If you have pre-tax money in any traditional IRA, the IRS treats all your IRAs as one pot. You can't just convert after-tax contributions tax-free. The conversion gets prorated. Example, $100,000 traditional IRA pre-tax plus $10,000 after-tax contribution. Convert $10,000, only 9% is tax-free, 91% is taxable. The fix? If you hold pre-tax IRAs, roll them into a 401k first, if allowed, to isolate after-tax money, or avoid backdoor if you have large pre-tax balances. Trap number 4, forgetting IRMAA and Medicare surcharges. Conversions count as income in the year you do them. 2 years later, high income triggers IRMAA, extra Medicare Part B and D premiums. 2026 IRMAA starts at $81 extra per month for individuals over certain MAGI thresholds based on 2024 income. A big conversion today could raise your 2028 premiums for years. The fix? Model IRMAA impact. Convert only enough to stay below thresholds if Medicare costs are a big concern. Prioritize conversions in years before Medicare enrollment if possible. Trap number 5, ignoring better alternatives or not planning for heirs. Not every dollar should go to Roth. QCDs or qualified charitable distributions can satisfy RMDs tax-free. Tax loss harvesting or charitable giving might lower taxes more efficiently. Also, if heirs are in lower tax brackets, leaving traditional IRAs might be better. They inherit at stepped-up basis in some cases. The fix? Run full scenarios. Your situation, heirs' taxes, charitable goals. Use free tools like the IRS withholding estimator or consult a pro. There you have it. The real story on Roth conversions in 2026. It's a powerful tool to lock in today's rates and build tax-free income, but only if you avoid these 5 traps. Do this right, and you could save tens of thousands over your lifetime. Do it wrong, and it costs you. 3 quick action steps. 1. Pull your last tax return and project 2026 income. 2. Use a free Roth conversion calculator like Dinkytown or IRS tools to test scenarios. 3. Talk to a tax pro or advisor before moving money. Small mistakes add up. You've got this. Knowledge is power. If this helped, hit like, subscribe, and turn on notifications. We're building a full 2026 retirement roadmap together. Comment below. Are you considering a Roth conversion this year? Yes, no, or maybe. What's holding you back? I'll reply to as many as I can. Thanks for watching Retire Smart Guide. Your future self is already grateful. See you in the next one.